Testing, testing. Okay, let's get into it. Yo, 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 guys. Welcome to the Doggy Yaps channel. And I have kind of rebranded and I kind of have, I'm testing a new format and hopefully you guys like it. And let me know what you guys think. So, let's get straight to the video to make sure that we get a quick recap on what's actually happening. So, why is Bitcoin dying? So I'm speaking to you at a Bitcoin price on June 7th, Sunday, at $61,805. That is an insane drop from all-time high of October, 129,000. And our Bitcoin market cap is at $1.2 trillion. So is Bitcoin really dead? Okay. So the first slide is how Bitcoin gets hit first. Bitcoin is actually a liquidity sensitive asset. When money gets tighter, when risk appetite drops, and when leverage starts getting unwound, Bitcoin is usually one of the first things to get sold. This is why Bitcoin gets hit hard before the rest of the market fully reacts. And this is not always about Bitcoin failing. A lot of the time, it is about how Bitcoin is the most liquid asset that people can always sell first. And that is exactly what the setup looks like now. So we're starting to see a lot of similarities in the market as we did in 2022. This I'm starting to see where this is kind of a slow pressure style drawdown, and think of it like this: like it is more like 2022, not like March 2020 when the market dropped from like 60K to 16K. In 2022, like let me paint a little picture for you. We are starting to see like I was saying, a lot of similarities, right? So in 2022, liquidity got tightened very slowly, financial conditions stayed tight, and risk assets got squeezed over time. And this is not just a sudden crash out of nowhere like COVID. This is a drawdown pressure move, right? It is stress building underneath the surface, and Bitcoin is one of the first assets to actually feel that pressure because we understand how it is the most liquid asset. So next slide is policy and macro angle, right? The crosswinds warning. So our policymakers at the Fed and the government are at a crossroads. They can tolerate tighter conditions and pain for in the short run, or they can eventually respond once the stress gets bad enough. And that is where the warning here gets really simple. If inflation stays sticky and if energy prices stay elevated and the policy stays tight, financial conditions can remain restrictive for a long time, right? The market starts talking about higher for longer. That just means borrowing money stays expensive for a longer period of time. And when money stays expensive, risk assets start to feel it first, like Bitcoin. And that itself is the macro warning that we are seeing now. Core mechanism: leverage flush ETF sellers and capital rotation. Okay, here's the fun part. Let's break this down into 3 steps, right? Leverage, ETF sellers, and capital rotation. One is leverage. When conditions get tighter, leverage gets unwound fast. That means that it's not just some calm selling, it becomes forced selling. And Bitcoin is one of the first assets to get hit when the unwind begins. And ETF sellers. Then you add ETF sellers. When the ETF flows start to run negative, that means institutional de-risking matters too. It's not just retail panic. Like when the institutional bid disappears, Bitcoin feels it immediately. As you can see here, we have a chart that I made with Perplexity, and 2026 has been a very up and down ride for ETF sellers. Like as you see, January we had 460 million inflows, February 1.5 billion outflows, March 1.5 billion inflows, and April had the highest amount of net inflows, which was at almost $2 billion. And in May, we had $2.43 billion unwound, taken out of the market, out of the ETFs. So that's why when liquidations happen and when these huge drawdown happens, we don't have a buyer at the bottom. Like we don't have orders that we don't have orders that are being filled. Okay. Next, now we have capital rotation. At the same time, capital is also still rotating. Some of it is hiding in yield, some of it is hiding in the AI momentum. And when capital is chasing those trades, Bitcoin can stay under pressure in the short term. This is why you can see Bitcoin weak while other parts of the market still find support. Like most of the market, they are chasing these AI momentum trades. They are chasing these huge valuations, right? And a lot of these institutions and investors are trying to buy something that can give them a quicker return and give them like yield in return, right? That's why people are buying bonds, right? We'll get into the bond section later, but that's just my little take. Geopolitics and oil pressure. This. Then you have the geopolitical layer. When energy routes get threatened and oil risk rises, like the Strait of Hormuz being closed, inflation pressure can stay alive longer. And when inflation pressure stays alive, the market starts to realize that the Fed has less room to ease. This is why oil matters. This is why geopolitics matters. And this is just way bigger than the crypto chart, right? Because dude, we all know that oil and energy is embedded in everything we own, right? To move stuff around America, to move stuff around the world, you need energy. To manufacture, to build anything, you need energy. Energy is literally infused in everything that we own. Just to go to work, you need energy. To power your house, to turn your lights on, you need energy. And when energy prices start to rise, you get real income erosion. And that's where it gets scary, because not a lot of Americans, not a lot of people in this world now have like extra income. Like it's hard for the middle class to survive when their paycheck is literally getting eaten alive just by being alive. Like that's the true scary part. Now let's talk about the Fed and our boy Kevin Warsh here. So CPI is one of the main numbers that the Fed watches. And you can see here Kevin Warsh being a little clean with his suit. And if CPI stays hot, the Fed has less room to cut rates. And when the Fed has less room to cut rates, that keeps financial conditions tight. That's when the phrase higher for longer comes from. It just means that the rates stay higher and borrowing stays expensive for longer, right? Capital gets more expensive, and and when capital gets more expensive, people have to chase bigger returns to pay for the capital that they've borrowed. And when money stays expensive, Bitcoin and other risk assets feel it first. So why is this a macro warning? This is not just some typical Bitcoin sell-off. This is not just some liquidation sell-off. This is macro warning that liquidity is tightening and that the system is still under pressure. Sticky inflation, tight policy, and risk-off positioning are all pointing in the same direction. When liquidity stays higher for longer, everything that depends on easy money feels it first. That's why this matters way beyond crypto, and this is why Bitcoin always reacts first. It's the most liquid sensitive asset that we have. So the Bitcoin supply squeeze perspective. Oh, where's my chart? Okay. Even in this setup, the long term the story of Bitcoin is not broken, right? Bitcoin supply is still capped at 21. Bitcoin is still scarce, and the longer term thesis is still built around the hard asset facing a world of unstable money. When liquidity tightens in the short term, it's actually a coil for the spring for the next higher up move, right? This is why I look at short-term liquidity squeeze and not long-term failure. The short-term pain, yes, is real. We all feel it. We all look at the charts daily. We all look at our portfolios daily and see the massive drawdown that we've had for the past year. But the long-term setup is still there. The main core thesis is still there. Bitcoin is scarce. It's still backed by energy, and you can't debase us if we hold Bitcoin, bro. Regulation and institutional readiness. Over time, regulation and institutional infrastructure tend to make Bitcoin more accessible, not less. Most large institutions still have very, very little Bitcoin exposure. And a lot of them are still watching, still waiting, and still under allocated. That means the long term story is still about adoption happening late, not whether Bitcoin still survives. And the real question is not whether Bitcoin makes it. The real question is when large institutions move first from watching to actively allocating. So when they're not so sidelighted anymore. And once that shift happens, the supply side gets even tighter. This is what makes Satoshi's gift so powerful. He could have launched this as an IPO. He could have sent this off to the banks and said, "Yo, I'm gonna launch this scarce digital asset." But no, he he gave it to the network of proof of work, and he let the coins get distributed to the people who actually believed in the project early and who believed in it first and held through the beginning. This is why Bitcoin is different. It was built to be owned by the people, not just the institutions. So here's a little clip that I want to show you guys where volatility is actually a gift to the faithful. And here, let me make sure that everything okay. I'll play this quick clip. Let me speed this up so that we don't get bored watching this. But the core main thesis of Bitcoin is still alive. We're still here.
Bitcoin went from 6 cents all the way to 36 cents and then it crashed down to 21 cents. And then another time, Bitcoin went from 85 cents all the way to $29 and then it crashed to $3. And then another time, Bitcoin went all the way to $213 and then it crashed all the way to $70. And then another time, Bitcoin went all the way to $1,100 and then it crashed all the way to $239. So the moral of the story is don't buy Bitcoin because you know it's going to crash again.
So that being said, volatility is a gift for the faithful. Like what Michael Saylor said, if all Bitcoin did was just go straight up, dude, these institutions would be buying it up and we wouldn't even have a chance. We wouldn't have an asymmetrical bet for the future. But Bitcoin being as volatile as it is, it gives us, the people, an actual chance to believe in an asset, to believe in an asset class where we can actually have that asymmetrical bet to the future, right? So it's hard, I know. It's hard to look at the chart and see that you're down a lot. It's hard to, quote unquote, time the bottom. It's hard to hold such a volatile asset, right? But dude, you just have to DCA. Like, that is the true secret of actually compounding wealth. People underestimate the true powers of compounding. Like, I don't me myself, dude, I don't try to time the bottom. I just buy every week. Like, when I get my check, a percentage of it goes to Bitcoin, a percentage of it goes to bills, and another percentage of it goes into my investments. You need to think longer term because you're holding an asset that's only been alive for 17 years. Gold has a market cap of 20 trillion because it's been around for 5,000 plus years. Bitcoin's only been here for 17 years. It's a little teenager. It's not even in adulthood yet. That's just my food for thought, guys. That's just my food for thought. And I hope you guys enjoyed this video, and I'll continue to make them if y'all enjoy it. And once we get a big enough community, I want to start doing these things live so that we can have more fun together and you guys can ask me more questions about Bitcoin and, just ask me more questions in general. I try to read every single comment, so if you have any questions about anything I talked about in this video, drop them down below and I'll answer them personally. Like and subscribe and comment what other Bitcoin topics you want me to talk about or what you're interested in. It was nice talking to y'all. See you in the next one.